July, Xi managed to, through his newly upgraded cyberspace administration of China, managed to bash in his own Chinese stock market through some tightened regulations. So it was a very, very tough month for Chinese shares. 12 trillion rand is being destroyed on the Chinese tech index alone from its February peak through a variety of new regulations and concerns about further regulations. So the chart on the right here shows that the NASDAQ Golden Dragon, which is basically Chinese tech shares, and the other line is the US NASDAQ, so US tech shares, and the massive outperformance that the US has had compared to China, with the Chinese Golden Dragon index down 48% from its peak in February, and possibly more today. There was some concerns that China is going to focus now on the gaming sector, which I think is unlikely. They did look at the gaming sector in 2018, and Naspers did fall at that time and recovered. In fact, it's tripled since that concern. And I think we're probably going to see a recovery like that going forward, that a lot of anxiety is priced into the market. And in general, the regulations are good for the long term, good for consumers and good for long-term growth. So what happened? Well, basically the Cyberspace Administration of China, like the CAC, or possibly the CAC, has extended its oversight to include overseas IPOs. And this is all about Beijing trying to control their data. As I said before, data is now seen as national security. Everyone's worried about their data, making sure no one else has access to their data. But removing Chinese companies from the US listings is not a concern. Many of them have already got listings on the Hong Kong exchange, and we'll probably see them migrate to Hong Kong over the next year, and that is fine. Index producers, fund managers, everyone's set up to trade Hong Kong. It's just a matter of accessing those shares in a different region. And yes, while there might be some short-term price pressures, those are merely flow driven, and those companies should recover. The educational sector did have some sharp regulations come through in July. And yes, part of that is concerning. The fact that those companies, education firms, have been banned from making profits, effectively nationalized. That is a concern. But it's very much focused on that sector, and it's very much focused on protecting consumers. And the associated regulations are good. They want to promote education within their economy, and education was being abused. So they want online teachers to be licensed. That makes sense. They want to limit the fees. They want to fine false advertising. They want to limit the number of hours that people can learn, and the ages. I mean, below 6 to do online courses is being prohibited. So a number of things to basically mirror what's happening in the rest of the world. So China is trying to improve its regulations, is trying to improve its standards. Yes, they are essentially controlled economy. So when it comes to making changes, they are swift and often draconian. And certainly this on the educational sector was definitely draconian. But it is moving in line with what's happening in the rest of the world in terms of focusing on its data, protecting its data, protecting the consumer, looking at antitrust issues. But there was also some positive news. We saw that China's antitrust regulator gave approval for Tencent, which Naspers is a shareholder in, to take search engine Sogu Inc. private. So certainly business as usual, and the regulator allowing Tencent to take that business private. And similarly, the Chinese authorities convened their banks, not only the Chinese banks, but some global banks as well, in the wake of the collapse of Chinese stocks, to understand what was happening and why there was such an overreaction, and what they could do to prevent that. So China is taking this seriously. They're not going to be too draconian about what is happening going forward. They have said that the regulations are very much focused on the education sector. They have said that they're not going to focus on gaming or healthcare or property sectors anytime soon. So I think that the markets, particularly looking at the impact that Tencent has had, or Naspers has had, the market's looking very much oversold. Yes, there are some secondary impacts, particularly for Tencent and Naspers, with lower lower advertising revenues, but I think it shouldn't impact their long-term growth. So we remain overweight emerging markets. And we use this as a buying opportunity. We topped up our emerging market exposure. We did a switch out of our global property ETF into our emerging market ETF. I'll talk more about that later. But we certainly use this opportunity to top up our exposure. And we just generally think that emerging markets have some tailwinds going forward. Yes, it could take a while for the Chinese regulations for that volatility to feed through. So there's no rush to get in. But generally, the dollar is going to stay weak, which is good for emerging markets. Chinese growth is recovering, and there has been some reserve rate requirement cuts in terms of supporting the economy. Increased vaccine supplies in emerging markets as a whole are going to see convergence of vaccination rates, which is good for emerging markets. And now, certainly more than ever, valuations are looking favorable, especially compared to the US. So we do think that this is a good entry point for China and emerging markets.